quite enough for us to shift our stance here on the broader markets. So let's go ahead and review what our views are right now. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. We'll start off with our normal equity indices outlook, taking a look at the major indices and where they currently stand and how we've seen some divergence here between the few major indices and what our views based on that are. We'll take a look at the fixed income markets, which had some starts and stops here over the past couple of weeks. We'll discuss what our views there, and take a look at some of the commodities that have shifted as a result of the moves that we've seen here in the fixed income markets before taking a look at our sector rotation model as we continue to see a fair amount of rotation, which is actually incredibly healthy for a market rally here. But what we are changing the format here for today to provide you with more ideas every single week is notable breakouts and notable breakdowns. And this is designed to give you every viewer here just more ideas of what's currently moving in the markets, stocks with positive momentum that's breaking out and stocks with negative momentum that are breaking down, so that you have simply more ideas to look at for today's trading day. But the primary question that I want to help investors answer from today's session is a clear understanding as to how are equity markets currently responding to this move lower here in yields that we have seen on the 10-year. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I want to share with you my technical charts and the research that we're currently looking at in terms of stocks that are moving that I think are worth paying attention to in today's market. So when we start off with the broader indices, the strongest of the indices at the moment is actually the S&P 500. You have very strong uptrend here on both the short and long-term trend of the stock. And we've really have seen quite a few days and quite a few weeks, if you will, of effectively slow grinds higher without any corrections of any magnitude, really. The momentum here is not particularly strong. It's not particularly weak. It's kind of in between there, and you just have a few big names dragging the markets higher here at the moment in the S&P, but it continues to grind higher and make new all-time highs. But that cannot be said here for the NASDAQ 100, which has started to fall behind. We saw the S&P and the NASDAQ moves in lockstep, but over the past couple of weeks, we really have seen both price and momentum stall here for the NASDAQ 100. So we're starting to see these growth and technology stocks no longer keep pace with the S&P 500. That's the first start, if you will, of bifurcation that we're starting to see. So when the S&P continues to print new highs and the NASDAQ 100 no longer confirms those new highs, that is, some instance of a continuation of the things that we've been bringing up for the past 2.5 months, which is the fact that new all-time highs are not really being confirmed by market internals and not being confirmed by other major indices. The Russell 2000 continues to not confirm these new highs. It really has failed to even make a breakout here above what is a minor resistance level here around 225 or so, and it started to turn lower here. And I think that if you look at the Russell 2000, it's really at risk of turning back and testing some major support levels here, as opposed to turning up and testing some major resistance levels as we would normally like to see in a healthy, strong, bullish market here. So but I still will continue to reiterate, these types of conditions that we see are not healthy, but that does not mean that it's time to short the markets. Unhealthy markets can go on for quite some time, and we've been talking about it for about 2.5 months now. It could go on for another 2.5 months, in my opinion. So these are things that you want to watch out for, but these are not necessarily reasons to go short the markets. When you look at the major markets, they are still very much in its uptrend, with the exception of the Russell 2000. And then when you look at the RSP, the equal weight S&P 500 index, this is really where we've had starts and stops with the Russell 2000 with the RSP, the equal weight index, as to whether it keeps up with the confirmations of the rally. And up until May 5th, it has kept up with the S&P 500. Since May 5th, it has no longer kept up, meaning market breadth has no longer confirmed these new highs. But over the past couple of weeks, we've started to see an improvement here from from RSP, meaning market breadth is improving. But the one thing I will say is that these 2 weeks do not make up for this past couple of months where we have not seen participation here in the broader markets, but it is moving in the right direction. But we've seen multiple times where it moves in the right direction and then stops. So this is one that we'll continue to pay attention to, especially in conjunction with sector rotation, to see if we have a little bit more confidence in this market rally here at the moment. But if you look internationally, if you look at EEM, this is really where it is concerning when you look across outside of domestic equities. We talked about this breakdown here in EEM a couple of weeks ago. It was a very brief breakdown and quickly resumed back into this channel or rectangle, if you will. But recently was rejected here at that trend line and is now broken back below this major support level. So this is looking fairly weak, especially getting rejected at the 200-day moving average and that trend line. We're starting to see momentum turn negative here on both, emerging markets. If you look at the KWEB, Chinese technology ETF, these are all things that are turning severely negative. And that's going to create also a bit of a drag here in US equities as well. So looking at international equities, I think is important for us to pay attention to. But the big move really has been in treasuries. Despite the rally that we've seen here in yields back into that 135 level, it's been rejected here at this trend line. And we'll take a look at inverse of that in TLT. But basically, yields are headed back down into the 115, 120 area here at the moment for treasury yields. And this continues to, grind equities higher. This condition that we're currently in, where equities just continues to grind higher, these lower yields force a kind of flow, if you will, into riskier assets and away from bonds. But if you can see here, we talked about this TLT breakdown here from last week. We talked about the fact that TLT broke down below it, but it came back down to this support level around 146 or so, which after breaking out, it tested this level multiple times and then simply tested it again. So this feels like much more of a range bound play here for TLT. And that's why we have a neutral, slightly bullish view here on TLT, is that it will remain in this range bound and hold this 146 level. So as bonds remain elevated, this is going to continue to put some, pressure here on equities to remain where it currently is. Now, what's going to move this? This really comes down to the few Fed policy decision-making events that are on the horizon here over the next few months that could potentially shift the views here on how fixed income or treasury bonds move. That's going to have major ramifications. So I would say right now, equities is extremely sensitive to where bonds are currently trading. So it's worth paying attention to. And then when we look at the commodities, gold recently rallying back up to the breakdown level. We talked about this breakdown last week. We talked about expecting a bit of a bounce here, but it's bounced even further than I had expected. It's basically retraced all the way back to the breakdown level here. And this is a potential resistance level that's worth paying attention to, this gap fill resistance level around 168 or so. If we get back up to that 168, look for potentially what could be a downside move here, especially as short term it is fairly overbought. And then crude back at this major support level here around 66, 67 or so. This 67 level has been a major support and resistance level for multiple months here since February, at risk of potentially breaking down lower here. So this is one that we should watch today. And especially if you're trading energy stocks or types of opportunities, this is one that I think could potentially break lower here today. And then when you look at the sector rotation, we've talked about here for the past 2 weeks now going into the third week about how sector rotation has come back to life. And we talk about the lifeblood of a rally is very much entrenched in seeing a fair amount of sector rotation or a healthy amount of sector rotation, which in the prior 2 months or so, we have seen very little sector rotation. But over the past 2 or 3 weeks, we continue to see more and more sector rotation. So some of the notable sectors that are moving here right now. One, technology made a new high here yesterday after consolidating and losing quite a bit of momentum here, perhaps starting to show a little bit of leadership here from technology, but so far by no means the strongest of the sectors. Industrials, a notable, I would say, sector here as it starts to complete a bit of a let's just call it a consolidation range here. Hasn't quite broken out above the all-time highs here, but it is just less than 1% away from those all-time highs, and a breakout here would be fairly significant because you've had a strong move here to the upside, a period of rest or consolidation, and is now potentially at a breakout level to pay attention to. But some of the real breakout levels here right now are healthcare. We talked about this trend line here in healthcare and how recently we broke above this trend line. And after breaking out above it, we've come back to test it as support and is now accelerating here to the upside. So healthcare, one of the strongest sectors here at the moment, showing a lot of strength in terms of positive momentum as well as breaking out to new all-time highs. You also see similar type price action here from utilities. $68 has been a high here for utilities for multiple months. We finally broke out above this 2 days ago. This targets the $71 level here to the upside. This would challenge the all-time highs and potentially break out even higher. And especially in a lower interest rate environment, defensive assets like XLU, utilities, real estate become a little bit more attractive, and we're starting to see price action reflect that. If you look at consumer staples, recently breaking out above its all-time highs around $72, multiple month top here around 72 pretty much since April, just breaking out here. So positive momentum on both short and long-term charts, coupled with the breakout here, is constructive for a continuation higher. So looking at the sectors, you have a lot of sectors on the move here right now, sectors that have not participated at all, like utilities, staples, healthcare, these types of sectors that are now participating in the rally, materials, industrials, all looking strong here, kind of taking away from communications, taking away from consumer discretionary, two of the strongest sectors in the past 2 months that are now falling back behind. So that is some rotation that we're seeing. Again, I hope that this rotation continues, because if it continues, that gives me more confidence in the equity rally that we see. But if we start to go back to where technology and discretionary continue to outperform here again, and that very well may happen, because we talked about this maybe about a month and a half ago, where we started to see a bit of rotation, but quickly reversed back. Right now, the question is whether this rotation continues or we simply just revert back to what we've seen here. So this is one that we'll continue to update you on every single week. But as we look for opportunities, like I said, I want to shift the format a little to provide more ideas every single time we do these sessions. And what we're scanning for are stocks that have positive momentum, that are just starting to break out, so you can potentially catch a larger move in a fairly timely manner, and vice versa, negative stocks with negative momentum that are starting to break lower here. And we want to just try to provide more ideas based on some of the feedback that we have received during these sessions. So CVS, this is our daily play here for today. Recently completing this bottoming formation here and breaking out. We've broke out above this $83 level. We've come back to retest it as support, and is now broken and now has confirmed that support level here. So our expectation is that we can see moves back towards that $90 all-time high. So we're scanning for stocks that have started to show some positive momentum on both short and long-term charts, and coupled with a breakout from a resistance level gives us the opportunity of what could be a quick move here to the upside in a stock like CVS, which is in one of the stronger sectors, healthcare, that we showed you here today. The next one we want to take a look at here is Philip Morris. Philip Morris, also same thing, short and long-term momentum starting to turn up here. Recently just broke out above this all-time high here, just above of $100, and now looking like it's going to continue moving higher here. So looking for positive momentum stocks that are just starting to break out are what we're trying to highlight here during these breakout and breakdown opportunities. Gilead in the healthcare space, breaking out above the $70 level, which has been a level that has held since the start of the pandemic, and just this week started to break out higher here above the $70 level. And this really targets 78 to the upside here. So a multi-year bottoming formation starting to break out here right now, opportunities that we see in healthcare. if you look at the Russell 1000 value index, so we talk about the growth index, but we're starting to see value actually outperform growth here again. And 163 or so has been an all-time high level that has held since May 5th. And we're starting to see this breakout higher here to the upside on the Russell 1000 value index. So looking at more quality, looking at more defensive stocks, those are the ones that are outperforming here in this current market versus those growth stocks, despite the lower yields, that we've started to see. We're also seeing some materials move. Lind. This is not a household name, but it's a fairly sizable materials name. Similar type, I would say, setup here, where basically since the May 5th highs, it has failed to really break out above this 305 resistance level. But over the past couple of days, have really started to confirm that breakout here, and has continued to move higher here on some fairly strong positive momentum here on both short and long-term trends. So that gives you, some of the stocks that are breaking out with positive momentum here in the broader markets. But we also, at the same time, in this current market, see quite a few stocks that are showing negative momentum that are starting to break down. One of the names here is American Express. This is what I talked about here on CNBC last Friday. I just want to give everyone an update. American Express, a very strong uptrend here, very strong move here this year, up 37% year to date. Well, it just broke below that trend line here at the end of last week and the beginning of this week, and we're looking for a continuation lower here. We could see a bit of a retest here and then a continuation lower here. This is why we took a debit spread. And this is a combination of both technicals as well as fundamentals. American Express is just simply trading at a very rich premium from a valuation perspective relative to its own history, about 33% higher than its 5-year average PE, about 13-14% higher than the highest valuation we've seen prior to COVID. So especially as things start to slow down here in the second half, stocks like American Express, I think, are at risk of a pullback back towards the mean for some of the stocks that have done very well, as reopening in the first half was stronger than expected. I think reopening in the second half is going to be a little weaker than expected. And then when you look at, a lot of travel stocks, they have fallen into the same category. Marriott 135 has been a major resistance level and support level here for Marriott since the recovery, and multiple attempts to hold this level so far has held. But just this past week, it's broken below this 135 level, and it's broken below the 200-day moving average. So this is one that we expect could potentially see some further downside here back into the 115 level here or so on a stock like Marriott. We're seeing a lot of travel stocks fall under the same category. Momentum is turning back negative. It is now breaking below major support levels, starting to see some negative downside here for some of these travel stocks. And also, like I said, some of the technology stocks are also falling into the same category. CrowdStrike, this is a name that we've liked for quite some time, but the technicals just do not line up here right now. 245 has been a major support or resistance level, broken out from that level here a couple of months ago, and it's just really failed to continue moving higher. There's just been a lack of momentum for it to continue moving higher here. So instead, we've now broken below this level. It's now come back to retest that level as resistance and has been rejected off of that level. So we can confirm that resistance level is holding, and it's likely to pull back towards this 200-day moving average around 210, 215 or so here to the downside. So we're seeing quite a few of these types of technology names come in, whether you're looking at CrowdStrike or Twilio, that fall into this type of category where on the long run, as you can see, higher highs in price no longer confirmed by momentum, and now momentum is starting to turn negative on both short and long-term indicators, and that indicates potentially a little bit more downside for some of these technology stocks. So with that, that covers what I wanted to share with you here today. I hope that this new format of showing you breakouts and breakdowns gives you a few more opportunities to research here for today's market, and gives you an idea of some stocks that are on the move here right now that have just started to break out here in the last couple of days or so, or just started to break down over the last couple of days, that you can use and research opportunities here in the broader markets. And our goal is to try to provide more of those to you on a daily basis so that you can have more opportunities to scan for in the broader markets. With that, thank you so much. I hope you guys have a great trading day.